Welcome to ETF Explained, a series on the Get Started Investing podcast. Each episode, we explain one ETF to better understand it and to help you build the skills to analyze any ETF. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
Bryce, I'm good. I'm very excited for this episode. We are talking about one of the most popular ETFs in Australia.
Yeah.
Also, same name, very popular in the US.
Absolutely.
We will get to that. We are talking about the iShares Core S&P 500 ETF. The ticker is IVV. Full disclosure, it sits in my portfolio.
Yep.
I believe it sits in yours as well.
No.
Does not sit in yours. But it sits in mine.
It does, yes. It doesn't sit in mine, but it sits in a lot of portfolios from the Equity Mates community. This was suggested by one of our listeners, Jen, and we've got a question from Jen about halfway through the episode as well that we will get to. But as always, Ren, when we're thinking about ETFs, when we're analysing them, we got to start with the name because there's a lot of information in the name that will help us understand what we are buying.
Yeah, so we can start with the iShares, which is the issuer. They're one of the big ETF issuers alongside your Vanguards and your State Streets, but they're and Beta Shares, I guess. But yeah, iShares, one of the big players. Core. Now, this is something that I think just iShares do. They have a series of ETFs that they labeled their core series.
Yeah.
Core and satellite investing is a way to construct your portfolio that we've spoken about before. But it is really just a label that they are giving it.
Yeah.
You still make the decision about what's in your core and what's
where
not.
it goes, yeah. I don't mind it from them though, to be
Yeah,
honest.
it's good. It's good. It tries to simplify the navigation of the hundreds of ETFs in Australia, the thousands that are in the US.
That's it.
Next up, we've got S&P 500. Now, that is the index that it tracks. It's the most popular index in America, the 500 largest publicly listed companies.
Yeah, so pretty straightforward.
Yeah.
So sum up, what we're working with here is an index-based ETF that forms part of Ren's core portfolio, and I'm sure many of your portfolios for those that are listening. Now, all the information that we're going to go through today, a reminder, you can get on the issuer's website. That would be iShares website. So let's crack in. The purpose of the iShares core S&P 500 is to really give you exposure to the largest companies listed on the US market, the top 500 largest companies, and to do it at as low a cost as possible.
Yeah. One thing that you'll often see discussed is that it will it's a good way to get exposure to tech. That's not the purpose of this ETF.
No.
We should be very clear. Like if you want tech exposure, there are ETFs that will specifically give you tech exposure.
Yeah.
It's just that right now, the US market is dominated by tech. But if you're holding this for 40 years, who knows what the biggest holdings will be in 40 years?
Yeah.
Could be...
NVIDIA.
That is tech.
True.
It could be... it could be Shein and...
Yes, Temu.
And ByteDance is tech. You know what I mean, though.
Goodness me.
SpaceX, is
Tesla?
that tech?
Is that tech?
Yeah.
They think they are.
Okay, better way to approach it. If we rewind 40
Yes.
years, it wasn't tech.
No.
It was, your Exxon Mobils
Yeah.
of the world. So what the purpose of this ETF is to give you the access to the 500 biggest US companies, and to do it at a low cost.
Ren, who's choosing those 500 companies?
So the index maker is S&P Global, but no one chooses. The companies choose themselves by the
Nice.
performance of their share price. You literally make a list of largest to smallest companies that are publicly listed in the US. They have to tick a few other criteria, but 500 the largest to smallest, and you draw a line under 500 and you say you 500 are in the list, in the index, and every quarter you redo that exercise, you draw the line under 500, and that's how you make the index.
Awesome. So that's the S&P 500 index. No one's sitting there making executive calls, captain's calls on what's in and out. So those are the basics: purpose, index that it's tracking, and I guess the information that you can get from the name. How do you think about this in terms of where it should sit in a portfolio, or the purpose for portfolio construction?
Yeah, so this is one of my core ETFs, as as iShares have helpfully put in the title, and it's low cost exposure to the US market that can tick away for decades because of the way the product is constructed, because it's an index ETF that rebalances every quarter. So every quarter they redo the list and they give companies that don't make the cut the flick, and new companies that have made it into the top 500, they add to the ETF. And in theory, you could do that quarterly exercise forevermore, and the index would just keep updating as new companies come to market and old ones fall away.
Yeah.
So it's part of my long-term core portfolio that I can just keep adding money to, sit it in a bottom drawer, and check in on it when I need it decades later.
I think something I've noticed in the Equity Mates community over the last few weeks as well is people coming into ETFs for the first time expecting them to be pumping out incredible short-term returns and getting frustrated that with index-based products, it's not getting them rich overnight. And so I think you really need to be conscious of these types of products that are low-cost, long-term core, are designed for long-term. And in the industry, long-term is 7 years plus. In our view, I mean, we look at it in decades, but you're not going to get rich quick overnight with these, but you will get rich over a long period of time.
In the industry, long term is 7 years because it's measured in the length of an investment manager's career. You know, like they want to get the next job or they want to be promoted. So but long term for us should be measured in the length of our working lives. It should be measured in when we need that money, and 7 years is kind of arbitrary. It makes sense for the industry, but it doesn't make sense for us. We can think longer term than that, and that's one of our advantages as everyday investors.
Absolutely. So keep that in mind. These are designed for long term, not that get rich quick overnight. Now, we have a question that's come from Jen. Let's give it a listen.
Hi, Bryce and Ren. Firstly, just wanted to say, massive fan of the show. You're doing a great job. Wanted to ask a question because you guys are doing a deep dive into the ETFs at the moment. I'd like to know the difference between IVV listed in the US and IVV listed in Australia. Which is better? Why would one be better than the other? What are the tax implications for each? And would one be better in this respect than the other? Has the growth of each been similar, or is one considered better? The prices are really different for the two ETFs, and I don't understand why this would be if they hold the same companies. Looking forward to hearing your answer. Thanks, guys.
Love it. Thank you so much for the question, Jen. A reminder, if you would like to ask a question, head to the link in the show notes and you can leave a voice message for us there. But a good question, Ren. I can certainly understand Jen's confusion here when you're starting to set up your core portfolio and the tickers are exactly the same but listed on two different markets. So I think to start with, don't panic, Jen, regardless of what you've chosen. Fundamentally, you are buying the exact same thing.
Yes.
You are, if it's IVV in America listed on the US market, if it's IVV listed here in Australia, you are still buying the S&P 500, and that is not going to change. So don't feel like you're making the wrong mistake.
Because here's the thing, it's not just in Australia and the US. Like IVV is an ETF that exists in other markets as well. If you're listening from the UK, you have IVV. Would you believe it? It's iShares Core S&P 500 ETF.
Jeez.
And the reason is that a lot of these ETF providers are big global giants. Vanguard, iShares, State Street, they have presence in every market around the world. And a lot of the time they'll have a global fund that then all of our different markets will feed into that global giant fund, in this case, the S&P 500. So this won't be the only ETF where you see the same ticker in different markets, but it's a great example that we can sort of illustrate how you think about it.
Yeah. So if the underlying investments are exactly the same, there's a few nuances that we can think about. When it comes to purchasing the ASX listed version, what you are doing is you are grounding everything here in Australia. You are buying it in Aussie dollars, your tax treatment is Australian, and it's listed on the ASX. So everything is in your home country, and you don't have to worry about how those things might operate overseas. You don't have to worry about international tax. You don't have to worry about finding a broker that gives you access to international markets. So everything is what they call domiciled or grounded here in Australia with the ASX version.
As opposed to if you'd bought the US version where you would have to fill out US tax forms. Because we're in Australia, there's a tax treaty, but potentially if you were investing from another country, you would also have to do a US tax return. So there's just much more admin. So we would say as a starting point, buy the Australian version, don't buy the US version. There might be some very specific individual circumstances where it makes sense to buy the overseas domiciled version, but buy the Australian domiciled version. Now, the one thing that we haven't spoken about yet is currency.
Yes.
And the interesting thing is whether you bought the US version or if you bought the Australian version, you're exposed to currency risk in the same way. The reason for that is when we buy the Australian version, the fund converts our money to US dollars and then puts it into the S&P 500. Or if we'd bought the US version, we would convert our money to US dollars and then buy the US version of the fund. Either way, our money is being converted into US dollars.
Yes.
So the currency risk doesn't differ. It's just all these other administrative hurdles that you've got to jump through.
And so that leads to Jen's second part of the question, which is around the slight differences in performance. Holding the ETFs in different currencies will lead to a different performance. Because you're exposing yourself to currency changes.
To make that really clear, either way, you're investing in US dollars, but when you invest in the US version of the ETF, the performance is just in US dollars.
Yeah.
Now, when you sell, you'll convert it back to Australian dollars, but you're looking at performance, which is purely how the ETF has gone. If you buy the domiciled version in Australia, then the fund will show you performance that they've already converted back to Aussie dollars.
Yeah.
So that's why you're seeing the difference.
And to answer the final part of your question, Jen, around the differences in price, here in Australia, it's about $55. Over in America, it's about $560 or thereabouts. Don't take that as any indication that it's different and the performance is different or the underlying funds are different. When an ETF lists, they actually just choose an arbitrary price for it to list. They just say, all right, we're going to start the ETF today at $10.
Yeah.
And so in Australia, they've decided to start it at X price, and in New York, they've decided to start it at Y price, and that's the main difference.
So that's one reason why it's different. The other reason is it starts at different times.
Yes.
Like the American version has been listed for longer than the Australian version, and so it's had longer to grow as well. If you actually look at IVV in particular, in Australia, they did a 15-to-1 share split in 2022 as well. So the price was getting too high, so they wanted to bring it lower. And so for each one share of this ETF you owned, they split it into 15.
Nice.
And so as Bryce said, don't take the share price or the unit price as any indication of like differences in value or anything like that. As long as what you're buying, the underlying ETF that you're buying is the same, then the share price is highly arbitrary, I guess, is the point.
So thank you for the question, Jen. A lot of information there, but that is the purpose of this episode, to go deep on specific ETFs and help you analyze them, because IVV is not the only instance, as you said, Ren, where you can buy the same ETF on different markets around the world.
Just to put a bow on it, we should be generally buying the Australian, your local domiciled version is going to be easier,
yes,
and you're going to get exposure to the same thing.
Yeah.
Now that's generally because we would need to look at the specific example you're thinking about to be specific, but just that's the general rule.
Now, Ren, you mentioned at the top, part of a core portfolio is all about low cost. Is this low cost?
It is. It is, in fact, the lowest cost S&P 500 ETF in Australia.
Wow.
So it's 4 basis points or 0.04%, or 4 cents for every $100 invested.
Amazing.
It's good.
That is low cost. You can sit that in the bottom of your drawer and not worry about A, paying fees or too much in fees, and B, ever having to choose a stock for the rest of your life.
Now, for our American listeners, there is actually one cheaper in the US. Vanguard are 1 basis point cheaper, 0.03%. But to be honest, either of them are very cheap and good options. Let's turn to performance. How's this ETF performed?
Incredibly well, as you would expect it to perform. So The 1 year return, just under 21%.
Mm-hmm.
We know the S&P has been going incredibly well. 3 year return, just under 12%. 5 year, 15.5%. And over the last 10 years, 16.4%.
Now, since inception, and this is of the original US fund in the year 2000, it's returned just under 7% a year. So you compare that just under 7% to the last 10 years of over 16%. The US has had a particularly strong run recently.
Absolutely. Nothing wrong with 7% a year for 20 years, though, that's for sure.
Yeah.
All right. What about distributions? Because not all ETFs pay distributions. This one does, though. Monthly distributions, its current yield is about 1.1%, or its current payout is 1.1%.
Yeah, 1.1% over the year.
Yes.
Yeah. Not each month.
Yeah.
Which is lower than, the Australian equivalent ASX 200 ETF, and that's just a function of Australian companies pay more dividends than US companies.
That's it.
Yeah.
Now, to close out, we always look at the top holdings. You need to understand what you're buying when you're analysing an ETF. It's no good just thinking that you're buying the S&P 500 if you actually have no idea what those 500 companies are. Now, the good news for you is we're not going to go through all 500 of them here today. We're going to go through the top 10. No surprises that the top 10 are primarily made up of the big tech companies that keep making headlines. In number one spot is Apple.
Yeah. Apple is number one. There's really a big three now: Apple, Microsoft, and Nvidia. But then it goes down: Amazon, Meta, Alphabet, Berkshire, Alphabet's second class of shares, Eli Lilly, and Broadcom. So quite concentrated tech. But as we started this episode, that's what it is like now. As the quarterly rebalance happens over time, that could change.
That's it. Now, you can find all of the information that we just went through on the website. We'll include a link in the show notes. And to reiterate Jen's question, if you're invested in the US or the Aussie version, don't stress, because you are fundamentally buying the exact same thing.
Don't stress, but maybe just buy the Aussie version.
Maybe just buy the Aussie.
Yeah.
So if you have an ETF that you would like us to cover, just like Jen did, we would love to hear from you. If you're watching this on YouTube, please comment below. We will make sure we do it. Or join us in our Facebook community group. Leave a suggestion there and we will add it to the list. As always, Ren, great to chat, and we'll pick it up next episode.
Sounds good.